Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. In today's episode, we're playing a bit of catch-up after a short summer break. Hopefully you all had a chance to recharge because the months ahead look packed with market-moving events. Today we'll focus on three of Europe's largest economies, the UK, France, and Germany. Each of them faces their own challenges, but the common thread is the tension between fiscal discipline, political realities, and the search for growth. We'll also explore some bright spots, areas where data is turning more positive and confidence may be stabilizing. Finally, we'll bring it all together with what it means for rates, spreads, and positioning for European credit. All right, let's kick things off, starting in France, where the political stage is heating up around the budget. Prime Minister François Bayrou is facing what amounts to a confidence test, not only in Parliament but in markets as well. He's proposing 44 billion in cuts to reduce the deficit from 5.4% to 4.6%. On paper, that looks like meaningful progress, but the bigger issue is political buy-in. To force the matter, Bayrou has called for a September 8th confidence vote. That move essentially puts every party on record either back his plan or risk political instability at a fragile moment for France's credit profile. Why does this matter to investors? Well, because France has historically been considered one of the safer credits within the eurozone core. Any sign that political gridlock threatens fiscal sustainability raises questions about French spreads, especially in a world where investors already demand more compensation for sovereign risk. If the confidence vote fails, you could see upward pressure on OAT's yields and, by extension, knock-on effects across the eurozone periphery. OAT spreads over government bonds are already at their highest levels since early this year. Now let's cross the channel to the UK. The government here faces its own budget hole, and the October budget announcement is shaping up as a critical test of credibility. The idea floated by a think tank to levy a windfall tax on banks has grabbed headlines recently, but it also spooked the markets. Banks have arguably repaired balance sheets and are navigating regulatory changes, and forcing a one-off levy could have unintended consequences, especially for lending appetite. But the fact that such ideas are being publicly floated suggests that the government is testing the waters ahead of October. Layer on top of that sticky inflation running well above target, and the Bank of England has little room to cut rates. Wage growth in sectors like healthcare and public services is adding to the problem. So, Chancellor Rachel Reeves and Prime Minister Keir Starmer are stuck in a bind. Markets want fiscal prudence, but the public expects relief on living costs and an improvement in growth. For credit investors, the Liz Truss episode is still fresh in everyone's memory. Recall how quickly gilt yields spiked, collateral calls cascaded through pension funds, and the Bank of England had to intervene. That experience means that even the hint of fiscal missteps can trigger a sharp repricing. As a result, we expect volatility around the October budget, not just in gilts, but in sterling credit spreads, especially in financials. So, let's turn to Germany now. The Eurozone's industrial powerhouse, but one that's been struggling to find momentum. Chancellor Friedrich Merz is leaning into fiscal stimulus. His government is proposing major infrastructure spending, defense investment, and targeted support to offset US tariffs on German manufacturers. The political framing is important here. Germany has long prided itself on fiscal discipline. This is a clear shift, signaling that Berlin is willing to tolerate higher deficits to stabilize growth. Recent data underscore the urgency. Second quarter GDP was revised down to minus 0.3%, a sharper contraction than first reported. Manufacturing remains under pressure, particularly from weak Chinese demand and energy costs. And yet, there are glimmers of optimism. Merz has pledged new tax incentives for investment and promised not to raise corporate taxes on Germany's Mittelstand, the mid-sized companies that form the backbone of its economy. Business surveys are showing some tentative signs of improvement. Now, from a credit perspective, Germany remains one of the most stable sovereign credits globally, but the real question is whether stimulus can revive growth quickly enough to avoid a prolonged stagnation. Corporate credit investors will be watching whether Mittelstand companies, especially exporters, regain confidence to invest. Now, so far we focused on the fiscal headaches, but let's talk about some bright spots that we've seen recently. First, the auto sector. July sales were up nearly 6%, driven by demand for plug-in hybrids and electric vehicles. That matters because autos are a bellwether for Europe's manufacturing base. Next week's Munich Mobility Show will be an important showcase, especially as automakers prepare for US tariffs. Stronger EV demand could provide a cushion against external headwinds. Second, the August PMI data showed eurozone manufacturing at 50.7, back in expansion territory. Spain, Sweden, and Greece all printed well into the mid-50s, signaling robust momentum. Italy and France have moved just above 50, while Germany is hovering around the neutral line. The UK, by contrast, remains in contraction at 47. For credit markets, PMI data isn't just a growth signal. It's also a gauge of pricing power and margins. If PMIs continue to stabilize above 50, it suggests corporates can defend earnings, which in turn supports credit fundamentals. So, what should we be watching in the weeks ahead? Well, first up, of course, is France's September 8th confidence vote. The outcome could swing French spreads and broader eurozone risk sentiment. The ever-present U.S. headline machine. Tariffs are in place at the moment, but there are more headlines around this to come with court rulings and the whims of the U.S. administration. The UK's October budget, high stakes for gilt yields, sterling credit spreads, and the credibility of the new government. And lastly, the EU savings and investment accounts. This initiative, part of the broader Capital Markets Union, or now labeled Savings and Investment Union, could reshape household savings behavior. If Europe adopts elements of Sweden's model, where nearly half of savings are directed into equities, it could be a structural positive for capital markets depth and liquidity. Now, let's bring it all together. On the rate side, the backdrop is challenging. Long-dated yields remain elevated, reflecting both inflation, uncertainty, and bond investor discomfort at high debt levels. This isn't unique to Europe. It's a global theme, but it still sets the tone for credit. On the credit side, fundamentals remain steady. Defaults are contained. Balance sheets, particularly in investment grade, are in decent shape. Spreads, however, are tight. As my colleague Van Hesser has highlighted in his US podcast, valuations look expensive, but the saving grace to credit is the total yield it currently presents to investors. Thanks to high government bond yields, even with tight spreads, all-in yields in corporate bonds remained attractive. It offers a solid carry for investors who can stomach volatility. The key to investors in the months ahead will be staying nimble. As we enter the final third of the year, markets tend to chop around. Portfolio managers who've banked gains so far will be sensitive to any shift in sentiment, whether from politics, data, or geopolitics. Therefore, our message to investors is stay vigilant, stay flexible, and don't assume smooth sailing into year-end. That's it for this edition of the Credit Compass. If you enjoyed today's episode, don't forget to follow, rate, and share. And if you have questions or topics you'd like us to cover, please drop us a line. We'd love to hear from you. For deeper research and credit ratings, please visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.